Hey guys, we're live today with Kashop on the Holy Macro Show. So, talking about gold miners, everybody wants to talk about gold, and there's a lot of good reasons to talk about gold. Gold looks amazing. It's been in a solid uptrend. Sentiment doesn't even look that insane right now, but we do see that hey, even though gold is going up, even though the metals are strong, there are some miners that come under some pressure from time to time. One of those miners is NEM today. And no better person to talk about that than Kashop. So, Kashop, what's your thoughts on this? And what do you see happening with NEM in the future? And is it a place where people should buy the dip, or should they look away from it and try to find somewhere else to buy?
So, if you recall, we had this conversation, I think, a couple of quarters back when gold was just picking up, and we talked about how I preferred Agnico over Newmont and Barrick, and Agnico is the number three miner, and I prefer that over the first and second name. And the reason for that is because Agnico had the quality aspect going for it. Like Barrick and Newmont, both of them have operations in pretty risky places, and Newmont, especially because of its growth through acquisition strategy, they had a lot of really tier two, or let's put it this way, crappy mines that they really shouldn't have bought, but it came as part of the package. So Newmont had this big acquisition of Goldcorp, followed by an acquisition of Newcrest, and they inherited all these assets, which kind of were so-so. And if you recall, in 2016 or 2020, yeah, it was 2020 that Elliott Management ran an activist campaign against them and told them you need to divest some of your assets, you need to consolidate, and that's how they created the Nevada gold mines joint venture with Barrick, which was pretty phenomenal. And it was actually a pretty good performing stock at that time. Like you had buybacks, you had dividends, did very well. But the problem with buying all these assets by acquiring other companies is that you inherit their problems with them. And it seems like until the last quarter results, investors didn't really pay attention to all the problems in their minds. And then all of a sudden, it's like it's all revealed, and that's the ugly, bare facts in front of you. And then investors didn't know how to react, so they started selling. When they started selling, it escalated a chain of stop losses, and it just got nasty really quickly. And so we saw this dip, the huge dip, in fact. So if I look at the chart now, I would say this is falling knife, don't catch it. If I look at the fundamentals, I would say it's not probably not as bad as the market makes it out to be. But if you ask me whether I would buy it, my answer would be no. Because why would I want to take on the risk of buying into this huge diversified miner with known risk when I can buy quality small caps, quality mid-tier producers, which are still trading pretty cheap. They are not priced for $2,700 gold. They're probably priced for $2,000 gold. And I don't need to take any of these risks. I do run the risk of buying, you buy a mine which, you buy a company which has a single mine, and then something goes wrong with the mine, then yeah, you're going to have a problem. But if you buy a basket of good quality mines, it's better than buying Newmont and its portfolio of okay mines, crappy mines, and one or two really good mines. So instead of buying this basket through buying a single equity, I would rather buy multiple equities and get exposure to only the highest quality mines, which are currently undervalued. So that's the reason that I would prefer those gold stocks over Newmont. And even if I'm not the type who wants to pick individual miners, I would just go with the ETF, the GDXJ or some other small cap ETF instead of buying a giant like Newmont. And that's big. That's like the reaction that we saw yesterday just reinforces why you shouldn't buy these big miners because it's too crowded. And when something goes wrong, the reaction is terrible. You're better off buying a basket of smaller miners or buying the ETF.
No, I agree. And when it's tough because this is an industry that people like you can guide people through, but the normal investor has no idea. They do think they have some idea, Everybody does. Nobody likes to think we don't know anything about stuff, but really, it's a really tough place to invest. For example, I'll talk to Kashop and I'll find something in a obscure country and say, oh, look at this value, look at this trend, look at a million different things inside of it, and basically you could invalidate a trade because of the country it's in, meaning it might have certain regulations, something might happen to miners in that country, and so on. So there's a lot of risk out there, and not to mention there's corruption, and this is something we're going to see more of. And I think this is kind of an interesting time to have this conversation, because if we are in a precious metals bull market, we're going to see things like you and I have seen in the past, which is next thing you know, people are investing in the explorers. And once it gets to the explorers, we're starting to talk about things like, oh, we're going to give a bunch of money to this company that is digging into the ground and they don't know what's in it. And that's kind of going to be the final play in the precious metal cycle. And we all know, and everybody who invests, I've never met one person who invests in gold miners who knows the industry in and out, who says these companies are run really well. Most people say the opposite. Most people would say none of these countries or companies are really ran well. These companies have a lot of problems. These companies have bad margins. So it's really a play on gold. It's really a play on silver. It's really a way to gather alpha for these things. It doesn't mean that you can't find something valuable and you can't make money doing it. I'm just saying it's an area where you want to be more careful than you usually are in other things. If you're buying the top 20 tech stocks, you're probably not going to deal with things like this. If you're buying small cap names in anything, or micro caps even, which is mainly the gold space, you're going to deal with things like this. You're going to deal with companies that are going to take major hits. They're not buoyed up by ETFs or fund flows or any of these things. They're going to take hits at times, and it's the same thing with uranium sector. And also, I wanted to say, you mentioned the other week about uranium. A name you mentioned did outperform the CCJ, did outperform the ETF. So, what are you looking at in the uranium sector right now that you think is a good value place, a place that's safe for U.S. investors or global investors to invest in to make money going forward if this is a uranium cycle as well?
So with uranium, the problem is that this entire sector has become a momentum play. And the momentum is all through the ETFs, URNM and URNJ. So what this does is it distorts capital flows. And when this happens, you kind of find it. So you'll have the consequence of you having these two ETFs is this: you'll have capital flows going into the biggest weighted names in these ETFs, and the companies which may have a better quality asset but don't have as high an allocation in the ETF, or don't have an allocation in the ETF at all, they don't get any of the capital flows. So you have a sector which gets kind of lopsided, and that's what we are seeing in uranium today. So if you ask me what I would buy, the answer is buy the crappy miners which have a higher allocation in the ETF, because as a trader, you want to buy something that will perform, and those are the ones that will perform. Whether they have good fundamentals, whether they actually will make money, as in will the companies make money in the long run, that's in question. But will the stock do well? That's a different question altogether. And so you have this massive divergence between fundamentals of the companies and what works in the stock market. So if I'm buying uranium names today, I wouldn't buy something that I actually think is good. I would buy something which I think is going to benefit from fund flows. It's as simple as that. And that's just because you have this tiny sector where the ETFs dominate. It's just bound to happen. Now, if you take the max 7, you take, in fact, the top 50 names in the S&P, even if they get massive fund flows, maybe they go up 10%, 20%. Max to max, in a year, they go up 40%, and that's it. With these ETFs, you can have these names go up 40% in a couple of weeks. And we have already seen this happen when fund flows accelerate. So when you have a sector which is moved by capital flows to this extent, then it makes sense to just focus on the capital flows and forget about the fundamentals, because the fundamentals are not going to matter. The one point where fundamentals may matter is, let's say you have a company which has among the top five ratings in the URNM ETF. They go on to buy a smaller competitor which is not in the ETF using their shares as currency. In that case, they get bigger, they get a higher rating in the ETF because now they have more shares outstanding and a higher market cap, and they grow that way. So if you can find the acquisition candidates, the companies that will get acquired by the big guys, then you can probably make money. The problem there is then it's a game of waiting. So you're buying cheap and you're waiting and you're waiting and you're waiting, and then finally you get frustrated and you just give up. And it's especially hard to do because you have someone buying the ETF, you both believe in uranium, you're trying to buy the undervalued company which is going to get acquired, and the person who owns the overvalued companies is going to make money every day while your position just sits there and mocks you, which is why it's really, really hard to do, and which is why I would just go with the flows and forget about the fundamentals in this sector.
I like that because I think that's a hard thing about ETF investing is it's only real, like, especially in the smaller ETFs. Sure, if you're buying the SPY or the Qs, like there's a bunch of ways to use that and outperform. But if you're buying these smaller ETFs in sectors like uranium or junior gold miners or any of these things, you're going to run into that issue, which is, yes, you could go and dig through and find the most valuable, best thing inside of it. Sure. However, that's not usually how it goes. Usually, the things that are the strongest continue to be the strongest. If that was the case, companies that just print money year after year wouldn't be flat most of the time. And that's really what happens. You'll see the things that have a lot of hype in it, they move. Things that are just cash flow positive, doing very well year after year, they're flat a lot of the time. And this is kind of a fascinating thing about why it's not even price action more than relative strength. You know, relative strength is such a great tool to use as a trader because, one, our main goal as traders is to outperform. We have to outperform the S&P 500. That has to be part of the goal. Sure, you can dice up whatever index you want to trade against, but for me, it's the S&P 500. And if we're trying to outperform those things, then we have to, and I'm not saying you're going to do it every year, but year after year, you should over a 10-year period of time. That means you have to find stocks that are stronger than the S&P 500 and stocks that are strong within the sector. And finding, digging through and figuring out, okay, like Kashab said, this is a very large component of this ETF that everybody's probably going to buy anyways. It's a company that makes sense. It's easy to buy. That's going to be kind of the trade of how you really pay attention to these sectors. So it's either buy the ETF themselves or go in and find those stocks that the hype, the momentum, and everything's going to get behind. So getting to another thing, speaking about hype and momentum, I've been talking about gold. And we've talked about gold already a little bit today, but this cycle is very interesting. And it reminds me of, like, so many people haven't seen like a real mania in a long time. People have seen manias like, some of the meme stocks a few years ago, or GameStop would be a short-term mania, but like a real mania, like something like Bitcoin, they haven't seen in years. And so, like, I made a post just the other day, and this was, it's funny. It has a story about when a guy actually wanted to murder me over telling him Litecoin couldn't be worth more than Bitcoin at the time, and basically wanted to show up to my house and how scary this guy is. And it's a whole, but also talking about people at that time. People were selling their homes to buy Bitcoin. People were getting tattoos for Bitcoin. Lambos was the the key phrase of the day. I mean, all of these things kind of continued to happen again and again as we went through this cycle. And it wasn't like hey, this happened for a month. Hey, this got on this website for a day or two. This was a full-on 2-year cycle that we all started out. Kashap and I have known each other since that around that time. And so we were idiots at that point, talking about buying it, whether it was a momentum play, whether it was a play to have something that's similar to gold in the digital world, whatever it is. We were idiots at that time. And then we were geniuses, and everybody else was geniuses right at the top. Kashal, can you talk a little bit about this cycle? Because people forget, people talk about the last one because the number is so big, 60,000. Yeah, that sounds really cool, but does anybody remember $100 Bitcoin to to $20,000 Bitcoin? That's a lot big. That's a huge move. It's 12,000%. So, Kashal, anything you remember from that time that we could talk about bubble wise that would kind of pertain to today and kind of look at it and go, gold isn't anywhere near a bubble yet.
Sure. So this was a very, very, very different environment in the sense 2016 you had 2014 was the Ethereum ICO, and by 2016 the Ethereum blockchain was kind of mature, and you had all these companies, all these developers rather issue white papers where they said they wanted to promise this or that, and literally all you needed to do was have a white paper website, and people would go and give you their Bitcoin or their Ethereum in return for the tokens of that project. So what this ignited was it's like the Levi Strauss, the picks and shovels play. So you have the San Francisco gold rush, and because of the gold rush, you have all these people coming in from New York and trying to find gold in San Francisco, and then the guys who sell the picks and shovels and the jeans to the so-called prospectors, they are the ones who make the big money. So it was kind of like that. So you had all this demand for Bitcoin and Ethereum because they were being used to finance all these projects, which just had a few developers. Some of those developers would even be anonymous, and you would have white papers. And people were investing based on the strength of those white papers. And it sounds nuts when you think about it, but that's how progress has always been. So you go back 100 years, you would have 200 automobile manufacturing companies. And then, over time, the landscape kind of gets winnowed out and the winners take over. That's the network effect. So you had that pretty much in crypto. Now, even though they were investing Bitcoin and Ethereum in these projects, the fiat on off ramp was just Bitcoin. So you did not have USDT, which is the dominant stable coin. So you did not have the concept of stable coins. You had none of this. You had Bitcoin and you had Ethereum. And Ethereum was just 2 years old. It wasn't as well known. It didn't have as many fiat on off ramps. So even if you wanted to buy Ethereum, first you took your dollars or your whatever currency you own and you went and bought Bitcoin on localbitcoins.com. That was the dominant portal. So you didn't have centralized exchanges like US had Coinbase, but outside US, it was more of local Bitcoins where you would go, you would chat up a vendor, and the platform would kind of act as an escrow. You would do a direct bank transfer and you would buy Bitcoin. Now, once you own the Bitcoin, then you were free to send it to multiple exchanges. And this was prior to KYC. All you needed was an email address. So you would go send your Bitcoin and you would get Ethereum, or you would go directly take that Bitcoin, put it into these white paper projects, which were ICOs. So you would go do all of that crazy stuff. And as the demand for all these tokens which are being issued went up. So I think peak of the 2017 bull market, you had 1,300, 1,500 cryptocurrencies, and they were all mostly based on a white paper and a promise. So as the demand for investing in all these projects picked up, the price of Bitcoin and Ethereum picked up, and Bitcoin more than anything because it was the dominant medium of exchange. And this is something that I think a lot of Bitcoin bulls fail to appreciate. The prior cycles for Bitcoin were very, very different because Bitcoin was gaining adoption as a medium of exchange. And in this cycle, Bitcoin is gaining adoption as a store of value. Two very, very different things. But anyway, so the mania was kind of there in Bitcoin because Bitcoin went from something like $300 all the way to $20,000. And the 14K to 20K, which just happened in the span of less than a month. So it was just wild, extremely wild at that point. But this time, it's not at all that way. This time, it's just everyone has this muscle memory of how much money the people made in Bitcoin the last cycle or the previous cycle, and they just think, oh, Bitcoin to 100K, it's going to happen. And for all the bullish talk that you see on the media, what's happening is that the price is badly budging. It's stuck in a range, and it's been stuck in a range for the last 6, 7 months. And we, on this very show, I think in March, we talked about what would be the exit signal for Bitcoin. And I came out and said, I've been in the space for a long time. I'm out because it just doesn't make sense anymore. And since the time, all you have had is chop, 7 months of chop, which I've been happy to sit out of. So this cycle, we have the same level of bullishness that we had uh, somewhere close to the last cycle peak, just that the price hasn't performed. Now, you kind of like to see this kind of level of bullishness when the price is going up. And here we are seeing this when it's stuck. So it's two very, very different markets. In fact, prior to the 2017 bull run, we saw a massive mania in gold stocks. So May to August 2016 was a massive bull run in gold stocks where you had all these new exploration companies which were just launched, and they would raise at 5 cents. The stock would go to 10 cents in a couple of days. Kitco would write them up, it would go to 20 cents. And that was a wild, wild time. And if you recall the level of bullishness that we saw with the explorers in that cycle, none of that prevails today, even though gold at the time was something like $1,300 or something, and right now it's double that. And yet no one cares about the explorers. One or two of them make the news, but broadly there's just no interest in the space. So it's two very, very different environments. Like the bullishness you see with Bitcoin today versus then, the bullishness that you see with the gold stocks today versus then, it just tells me that the gold stocks are nowhere close to a mania, while Bitcoin is already in the mania stage. Now, does that mean both can't perform? Nothing of that sort, because everything is driven by liquidity, and the Fed is cutting rates. The Bank of Japan is probably going to start printing soon. The People's Bank of China is already printing. The Fed, any moment, it's just a matter of the elections being over and they probably start printing. So we are in this massive inflationary cycle where everything goes up. However, if you look at sentiment, momentum, and the fundamentals, the gold stocks have a lot more room to run before they get to the mania stage, whereas Bitcoin is already at the mania stage, which means it probably doesn't have as much room to run. So even though gold is hitting all-time highs and Bitcoin isn't, I would still overweight gold over Bitcoin because this has the momentum and it's nowhere close to a mania.
It's interesting because it's somebody brought this up to me the other day. In full disclosure for people watching the show, I am long gold and Bitcoin at the moment. Um, but when you something that it's my buddy James, and he was in one of our original groups, Kashop. He brought up an interesting one, which was 2020 when gold started to move and had a very good run in 2020 into August, and then it stopped, and then it just went range bound. And then Bitcoin broke out right after that and continued higher. And he was like, it's kind of interesting. That's the opposite scenario this election. And it is kind of an interesting thing to think about. And once again, it's if you're a very long-term trader, it's in an uptrend. I'm going to own it. If you're a short-term trader or you don't have a position, like I don't know why so many people, I keep mentioning this, and this is the thing you and I have talked about a bunch, is it's just going to be boring. Bitcoin is very boring. You're stuck in a range until it gets above 72K. It's not really going to move. And also, here's the thing that's crazy to me that just occurred to me as you were talking. When people talk now, when back in the day when Bitcoin was said to go to 100K, when it was sitting at 4K, or that was when those 100K started was around 3K, 4K. That was crazy. That's a huge move. That's a lot of money. Now people are like hoping for 100K gold. It's a chip shot. It's very close. It's not going to be it's not 100% move. It's nothing that's going to be crazy to a point where people are going to be like, I made all my money in the world by trading Bitcoin. It's a quick move. Sure, there's other coins and currencies, but now the market's getting a lot bigger. Those moves that we saw back in 2017, as crazy as they were, we'll never see that type of a movement in crypto again. Now, people are going to probably write us at this moment and go, it's going to happen again, Bitcoin to a million or something crazy. But it's like, it's never going to be like it was. You can't go from dollars to 20,000 in a couple of years in any asset. I don't know any asset in history that ever did that. The Tula bubble didn't move like that. It did make a huge move, but it wasn't to that level. So I don't know any asset bubble that moved like that in history besides Bitcoin. And even over time, it's been our biggest bubble in our lifetime. And so many people are I think people look back at it. It's the same thing people do to every stock, every every buy and holder does over time. Hey, go back as far as you can, see you make money. And it's like, well, that's saying that the past is going to be like the future. And we don't know that for certain. We do know that, hey, Bitcoin's market cap is a lot larger these days. Bitcoin's already at 70,000, close to 70,000, hitting 100,000. Sure, it could hit it. But does that mean it's going to be the best performing asset again? Probably not. So there's a lot of areas, and I think this is where it comes into play of finding these gold miners. Even small gold miners could be the ones that make a 1,000% gain. Some of these 10x things, if you're really looking for 10x things, which most people probably shouldn't, but if you're really looking for 10x returns, they're going to be found in different areas every single cycle. They're not going to be found in, hey, I'm just going to buy Bitcoin again and it's going to be the same 10x return every single time, or 40x return, or 20 or 120x return. Like, these things aren't going to continue to happen again and again. It's going to be a, hey, let's go find the next part of the cycle. Okay, we're in a precious metals bull cycle. Where are all the gold miners? Well, they've been getting hammered for years. So maybe some of these could move 10x. And that, I think that makes a lot of sense. And the next chart I brought was just this is old, so I put this up a while ago, and this is when you and I started talking about when I went to the gold store, and nobody was talking about gold. They were taught their premiums to sell it to them was still pretty insane because they had too much gold. So their premiums were high. They didn't even want to, at some stores they didn't even want to take gold at the moment. So all my friends are saying, like, they're not taking gold, or the premiums are really high. I said, are people coming in and buying like crazy? They said, absolutely not. So, I mean, we're in this scenario here where it's like, this does not look like the past cycles that we've seen in gold. But what does look familiar is these breakouts, breaking out to a new level out of these major basing patterns, like what happened in the early 2000s, what happened in the early 70s, and what's happening now today in the early 2020s. So I think the scenario here is that Bitcoin, that was a bubble back in 2015 all the way to 2017. This in gold, this 30% move, this is not a bubble. This is the beginning of a new trend. And it looks very stable too. It's not like a crazy trend that's like, looks like a Wall Street's bets and a bunch of people plowing into silver and seeing a nice spike and getting out of it. This just looks like a nice, solid trend. Stay involved in it. It's going to have pullbacks. It's going to be messy, but at times you're going to want to just put out a trailing stop and just kind of get out of the way, because this thing could really take off. And there's a lot of areas inside of it that we've been talking about that will probably follow, including uranium. Uranium during these cycles usually makes a big move as well.
Yeah. So going back to the Bitcoin chart that you showed, so I sort of have a theory as to why. I mean, sure, the 2016-17 market was a bubble, but I have a theory or a framework to put that bubble in perspective. So, if you look at the 90s, which was among the best times for the US economy, and if you look at what happened to the dollar, so China started globalizing sometime in the mid 1980s. India started globalizing right after the 1991 reforms. And then you had this crisis in Mexico, and what happened was pretty much the entire world started to dollarize because global trade, the barriers to trade just melted away, and the dollar started being used as a currency everywhere. And of course, the Cold War ended, and all the euro dollar deposits, they made their way into the system. And it was a time of massive dollar adoption. And because it was a time of massive dollar adoption, US consumers had it extremely easy. In fact, that entire decade, I think the stock market boomed, the economy boomed, and consumers didn't really face as much inflation. It was kind of like a golden period. And all of that happened as the dollar was gaining adoption as a global medium of exchange. Now, it had already been a global medium of exchange since the Bretton Woods Agreement. It was just that because of globalization and trade picking up, it became much more involved, it became a much bigger part of global trade. So you saw that nice adoption cycle for the dollar driven by trade. And in 2016 to 2018, you saw the same kind of adoption cycle for Bitcoin driven by trade. In this case, the trade was in the digital economy, which was just starting to take off, which is Ethereum, which is all your ICOs, which is your trading, which is your arbitrage between the many exchanges, which is people adopting Bitcoin instead of their national currency because the national currencies were unstable. So you had this glorious period where Bitcoin mushroomed into a global medium of exchange, and that drove the price gain. Now, later years, what's happened is that it's matured. The adoption rate within the economy is already as close to maximum as it can get, and now it's a store of value. And it's the same for the dollar. So the dollar starting in 2000 had a pretty nasty bear market, and it's recovered, it's done okay. But in my opinion, or my theory is that you will never see the dollar gain as accelerated rate of adoption as it did in the 1990s. And similarly with Bitcoin, you will not see it gain that rate of adoption into the next decade. That adoption rate has peaked. Now, does that mean there won't be dollar cycles or Bitcoin cycles? Of course, there will be, but that's just the way that I would put this move into perspective.
No, that's a good point. I think generally the interesting thing about markets is one, there's bubbles, and the reason why people talk about bubbles and hate bubbles are for a few different reasons. But one of the reasons that I find fascinating is that most of the time, and for example, and we learned this back in 20, God, I mean, that really I learned this back in the first gold bull cycle is that everybody says everything's a bubble when they're not in it. It's the same thing in 2017. It was stupid. It was a bubble, and really, when we were getting calls that it was a bubble for Bitcoin, it was when it was hitting $1,000, and then $3,000 it was a bubble, and then $5,000 it was a bubble. The problem with bubbles is we never know when they're going to end. So how do you, there was an interesting conversation that happened, and to your point and your thoughts in Market Wizards, hedge fund Market Wizards, Cole Moshe, and he talks about bubbles, and Jack Schwager says, how do you take advantage of bubbles? Inherently, you can't because it's a bubble, and inherently they go away. And really, trend following models kind of answer this. We can stay in these types of trades. We're not going to catch the top. We're not going to catch the bottom. We're going to catch the meat of the move most of the time. However, if you're trying to do better than that to really catch bubbles, I think it's trying to ride that trend. It has to be number one. So being willing to take the small drawdowns, things like gold miners, being willing to take 20% pullbacks at times, inside of a gold miners is nothing really. 30% pullbacks will probably be something you're going to have to deal with if you're buying a gold miner. But being in those trends, understanding the volatility of the product you're in, but also getting to that point where the mania has taken over completely. Seeing it on the cover of every magazine, like that's the stuff we're not seeing in Bitcoin today. But we are seeing that. We did see that in 2011 in gold. We did see that in 2016, 2017 in Bitcoin. And we're seeing it, to a very small level these days. But it's not to the same level that we saw back then. Back then, the mania was so crazy that the price couldn't keep going up. Who was left to buy? I always ask the question, who's left to sell when something's going down? But when you're going up, and who's left to buy Bitcoin anymore if it's sitting there at $20,000? And that was a major psychological resistance level. and everybody we knew owned it at that point, and everybody that we talked to that said we were crazy for even owning this currency that doesn't have any financial backing, which is, I guess they never heard of the US dollar either, or any fiat currency for that matter. You had all these people getting very excited about it, and I think that's kind of the best tell to me, is when people who have nothing to do with gold and they hate gold and they start to go. Even Buffett, the silver one, Buffett coming in and buying silver was a very interesting study too. Maybe we could talk about that at another point. But you know, everybody in the world started buying Bitcoin, and then the same in 2011. We still both. I'm sure you have stories from people, and I have stories from people who bought gold in 2011, and they still are like mad about it. There's till this day they're like, I can't believe gold's gonna crash. Gold's gonna crash. I bought it in 2011. Like it always crashes, and like you're always gonna just buy the top of something. So I think it's a bubbles are fascinating to me because I think it's a thing that one as a trader, like we have to be involved in some way. When it's happening, great. But also we have to be understand where we're at and not get too caught up in the mania to the point where we're like, hey, we're gonna just stay in this thing forever because it's never gonna go down. It's a new paradigm. Bitcoin to 100,000, 200,000, 5 million. Whatever. Just it just never stops. Like these things all end. So I think it's a really interesting subject to have today, especially leading into what everybody thinks is a bubble in gold, and the fact that maybe we're going to see some new bubbles coming up, especially if, like you said, liquidity is coming back into play. So when you're talking about that, what do you think? Do you have any thoughts on the election? For me, obviously, it's just what's my back testing telling me, what's seasonality telling me, and most of the time where I just think that the market's just gonna basically continue to move up. I think everything will be fine in this presidential cycle. I think the market's probably going to rally heavily in November, but also once again, as you know, Kashab, I'm just going with the highest probability bet. That's what I do as a trader. You're more fundamental. What are you seeing in the election? Do you think Trump's going to win? Do you think Harris is going to win? Do you think it has anything to do with the market going forward?
So you have this usual conversation around every election where if the Democrats win, then solar stocks will do well. If the Republicans win, then the other energy stocks, oil, natural gas, those stocks will do well. And if you actually go and look at it, it doesn't work out that way at all. So I would just completely fade all the hype around those obvious trades and look for where are the opportunities where I can actually make money. Now, both candidates, they are going to have a higher rate of spending. They're probably going to have a higher rate of tax. So that's going to be in common. What's going to be different? Maybe their approach to regulation would be different, or maybe something else. You don't know what it's going to be, but the obvious trade of, okay, if Kamala wins, then we have to buy the stock on day one. That's not going to work. So I would just go with, let's see what the election brings. Let's see what happens after that, and then take a trade. Now, does that mean I'm not watching something for a buying opportunity? No. So I know what happened in the previous cycles, and especially being in commodities, I have a sense for what kind of stocks could possibly move after the election. And let me just talk about one of those. So there's this company called Next Decade Corp, which is building a massive LNG terminal in Texas. So it's one of the biggest infrastructure projects ever undertaken, and right now, and they have complete approval from the FERC, which is the Energy Regulatory Commission. And what's happened is they started the project, and a bunch of greenies went to a court and said, "You cannot allow this project to proceed." And the court said, yes, we side with the Greenies. And they said, halt this project. Now, you have a situation of this. Now, this is completely political. Now, if Trump wins, is the court going to have the same level of clout on a massive project in Texas, which is kind of the home base for Republicans? Of course, it doesn't. If Kamala wins, maybe. Now, this stock is being priced for a Kamala victory. So I would buy it ahead of the election, even if there's a chance that Kamala wins, because my downside is minimal. So I would look to put on trades like this. This is one example of many such trades. So I would like to put on trades like this and not worry too much about the binary outcomes. So the binary outcomes, you already have people betting on it through, I don't know what's the prediction market called, but you have that, and then Interactive Brokers has all these event contracts, and the speculation at that level is just crazy. And as a trader, I have no edge over there. So it's like, I don't know how to play poker. You put me onto a poker table, I'm pretty much going to lose. And that's kind of how it is with trying to trade the election this way. But if I can find opportunities of this sort, like next decade, which I mentioned, so then I put the odds on my side. And those are the trades I would look to take.
Yeah, I think that's important. And it's the interesting study of all of these events, which is understand that there's an event happening. This is the thing that all traders can do and make money doing. You understand that there's an event happening. There is an election coming up. It doesn't matter, and this is the thing people take me saying it doesn't matter to mean I'm harping on your politics. I really don't care, and that's the thing. Actually, that's my political stance. I really don't care. That's what I'm running on 2024 as well. But I really don't care if Trump wins, if Harris wins. But what's really happening is there's an event in November, so you're going to see volatility and implied volatility rise in a lot of products after the event. That I don't know. I'm not telling you what's happening in the market, but I will tell you that implied volatility is going to drop off of a cliff in most products. So most of the time that leads to the market going higher. This is what brings these after election rallies that seem to happen so much in election years. So once again, it's a understand that an event's happening. Play that how you will. You can play it in a way where you go, okay, well, I'm gonna buy call. I like the S&P 500. I'm gonna buy call options on the S&P 500 to the election. I'm gonna sell them the day before the election when the implied vol is at its high, basically, and I'm gonna get out. Or if you think the S&P 500 is trash, you short the S&P 500, you buy puts. And the thing is, you're probably going to make money either way. And the reason, and you'll make more money if you get the directional bet right. But why I'm saying you'll make money either way is because when the trend is going when the trend is going that direction and implied vol is moving higher with it, now you're making more money. And even if the trend is going against you and you buy put option, let's say the S&P 500 moves up, you buy put options, implied vol is rising, and you're making money that way as well. So there's a bunch of ways to make money in these types of environments, and I think after it is a perfect time to, like you said, and see where the trends show up. And there's a lot of them showing up already. So like you said, with the commodities, there's a lot of things that are already moving and making moves that look good already.
So speaking of implied volatility, I think you shared this story when the GameStop saga was happening. The stock had that crazy up move, and if you bought puts, you made money, even though the position was actually moving against you, just because of the rise in implied volatility. And you do get those crazy scenarios at times, which no one can even think of. But as a trader, that's kind of where your edge is. And I believe you did buy those puts and make money off the premium at that time, didn't you?
Yes, yes. So, I mean, if you look at it in like you could do that type of way of looking at it, and that's perfect. We could buy puts on it going the wrong direction, but I think the thing that everybody has done, and the real easy way to learn this type of strategy is by doing something really stupid. And that's how I learned everything trading. I learned everything as a trader by doing stupid things, which is why I tell everybody all these lessons all the time, because I am part of those lessons. I have learned them the hard way most of the time, which is, you first start trading, you learn about options, you see that there's directional bets using options in a sense, but you buying calls or puts. So you buy calls on something and you go, hey, there's actually a really good directional bet using put options if I was to buy call options on, let's say, Apple during earnings, and Apple I think is going to have a great earnings, and that stock is going to go higher, I'm going to buy calls. And then you buy calls on it. You buy them out of the money. You buy them 10% out, and it actually hits. Like it gets back into your strike. You get that 10% move in Apple, and you look at your call options, and they're actually worthless. And you're like, how did that happen? And it's because, and maybe not worthless, maybe they're worth something, but you bought them, and the problem and the thing that you did that was dumb, that I did, that was dumb, which was buy them at 3:30 p.m. right before the market close, right when all the hype for the earnings are there. And then as that move happens, you all the implied vol falls out of it. And so that premium that's priced in from the volatility falls out of your trade completely and you lose everything. But then you learn the opposite scenario. What if you bought call options on something 2 months before earnings? Well, you actually catch that implied premium. So now that implied premium is moving up with you, you sell it right before the earnings date, and then you make money. So I think it's a really fascinating way to look at events because event trading is really profitable, but you have to understand that like you're not trying to predict the events. So many people think event trading is predicting the events, and no, that's not it. It's predicting the volatility of a product you might be trading. It's understanding after an election that volatility will be coming out and how could you take advantage of that and coming at volatility coming out. So if you're buying options, call options and put options as volatility is coming into options, what would you do when it's coming out? Well, you would sell options. So you could sell credit spreads. You don't have to sell, naked puts or calls. I'm not telling anybody to do that, but you could sell credit spreads and make money that way. There's a ton of different ideas and different ways to take advantage of the trade. But so many people are going to get hung up on exactly what you said at the beginning. Well, I've been reading this analyst and Trump's in and Trump's going to do tariffs and he's going to do this and that. And they're never going to look at the data and just go, usually after the election, small caps and the reflation trade kind of take off again. And other things like technology kind of lags for a little bit and then it starts to catch up again later. Like these things just happen every single time and it doesn't matter who gets in office. Another interesting study, one of the most fascinating studies that I ever did, which was take all the elections and go, how does the market perform under Democrats and how does the market perform under Republicans? It's almost identical. Like it's literally almost identical. Like a few percent here, a few percent there, basically is the difference. Democrats usually outperform. The reason why is supposedly spending, but also if you look at that, Republicans actually spend just as much as Democrats. So it's all just kind of, to me, it's you have very similar things happening to the economy, and it doesn't matter who our president is or what party they're in. And people are going to disagree with that and say that sounds ridiculous, but I'm just telling you the data. I'm not even telling you what I think. I'm just telling you the data.
Yeah, and if you're an American, you're living in the United States, and you're too close to it, but if you were to give an opinion on, let's say, the Mexican elections or the Brazil elections, you would probably be a lot more objective about it because you don't care, you don't have any emotional attachment to it. And I think that's something that trips a lot of people up. And in India, like elections for the last decade, in fact, it has been one candidate is a shoe-in. So there is really no talk about volatility around elections because you know the outcome. But it wasn't always like that. And when you have these contested elections, you kind of get emotionally charged. But if you look at the same data and just think of it as it's happening in a different country, then you wouldn't really care. And I think the people you talk to, the people I talk to, I think that's kind of where our difference lies because when we talk about US elections out here in Dubai or pretty much anyone I talk to, they just look at it as a curiosity, like there's something happening and okay, it's like all in the news and you have these very public cafes which people laugh at, and then of course you have the assassination attempts which kind of get discussed in a more serious tone. But overall we just look at it as a curiosity, the same way we would look at Brazil or Argentinian or Mexican elections. We don't look at it as, oh, it's the United States of America, it's the reigning empire of the world, and we really don't have an attachment to it. And I think that makes all the difference when it comes to trading elections. Because if you're too close to it, you're going to get emotional. And when you get emotional, that's going to reflect in your trading.
Yes. And So I think that's the reason why I think so many traders that are very talented traders are kind of outside of those systems. Most of the people who are traders are libertarians, or there's some other background. Or they're anarchists or something. They have some other background that kind of keeps them outside of it. And I don't know if it's something that most traders have to be so objective, and that has to be part of their personalities, or if it's just things we've read or grown up. But it's kind of interesting that that kind of is a commonality that people don't talk about. It's very common for that to be kind of the view, and then the normal person being so hyped around it because, of course, I mean, it's a I always tell that story about the 2020 election and like me being able to be like, oh, that's an opportunity, whereas everybody else around me is panicking. And that could be me just being a different divergent brain, basically. I don't know. Or it could be the fact of my politics. I have no idea, but I know that it helps me to make money. It helps me to look at it and go, okay, well, who's left to sell here? Because really, at that time, it was like we had every single. If you just looked at it objectively, this year doesn't isn't as clear to me. Like that year, it was perfectly clear. By the market, it's going to explode higher. That year was in 2020. Everybody was scared. Everybody was still blaming COVID. Everybody still said it was the end of the world. Like it was the election was going to be terrible. Everybody was going to die. Everybody was angry at each other to a different level than they are this year. And then also, if you looked at hedge fund positioning, and then if you looked at ETF positioning, everybody was short. Every single person out there was short, basically at level, at least not 100%, obviously, but to levels I've never seen before. So it was easy to go, okay, well, here's all the data. And I think that's what makes you a good trader over time is the ability to just look at your data and go, okay, that's what I'm doing. And whether it's right or wrong, just looking at your data, having a plan that works most of the time, a plan that makes money most of the time. It's not going to work every time, but if you have a good plan that works and you can make money most of the time, you're going to make money as a trader, but you have to have the conviction to just follow that plan. So I think at the end of the day, the election's going to happen. The data still points to probably upside after the election. But I also haven't seen many election years where it's just been so strong before the election. Usually it gets a bit choppy and then we break out. So that's why I'm a little bit torn on it, but I still am in the camp that the market will probably rally to year end. Then we might have some things to think about. Like you said, liquidity is coming into the market, but there are other things under the surface. If you want to end on anything, I got to dip in a minute or two, but do you have anything to add, Kashap?
Um, Not really.
Okay.
So yeah, I think just let every trade run because everything kind of seems to be running pretty well without much of a drawdown, in fact, which is the surprising part. It's just been one smooth uptrend, except maybe crude oil, and there you're seeing a little bit of chop. But other than that, and I think orange juice is just running beautifully, and
Yeah,
something that
orange juice is
yes,
running. If you look at a lot of these the commodities, a lot of them are running nicely. Lumber for the first time in years just gave me a new buy signal, which is pretty crazy. It's a band squeeze breakout signal on lumber. I haven't gotten one of those since 2020 probably. If you look at some of the energies today, they're moving beautifully as well. Up to almost 2.5% for crude oil right now. That's interesting. Silver's been running just going crazy lately. Platinum's also joining the party finally. Copper looks like it's trying to bottom out and move higher. Palladium, we talked about it. Shout out to Sam Gatlin as well. We've been talking about this one a ton. So Palladium's been moving. So all of these look very interesting. I think the thing that's really going to set this apart is if after the election the dollar really crashes, that's going to tell us something.
yeah, true. And lumber, I can tell you why it's moving. I think the softwood duties on Canadian lumber that's going to double from next year. And palladium, you have this Russian news saying they're going to impose export controls or tariffs. And I think you pointed this out. It's the same thing for wheat, where Russian exports are kind of going to slow down. And if the same thing happens with fertilizers, so Russian exports have kind of been on a tear with respect to fertilizers. So if that kind of gets stopped, then we are going to really start to see the inflationary cycle really, really pick up. And you have a little bit of a dip in the dollar, and I think that's it. That's going to kickstart so many trends, and it's probably going to be maybe not the same as 2020, 21, but something very similar. And on that note, I think it's something that we can all look forward to as traders, and we can end there.
Nice. All right, guys. Thanks for joining us, and we'll see you soon.